What is the debt of ServiceTitan? That is the question on the minds of so many people who are retired or just weeks away from dropping their keys on the desk for the last time. And you need to pay attention, because when you are entering the distribution phase of your life, the rules completely change. You no longer have the luxury of time to recover from a bad financial investment or a company that is drowning in its own obligations. So let's look at this company, ServiceTitan, which trades under the ticker TTAN, and let's figure out if their debt is a threat to your security, or if the fear around it is completely unjustified. The fundamental problem here is that when a giant tech company goes public, the headlines love to scream about numbers. They talk about hundreds of millions of dollars in losses, they talk about massive operational costs, and for a retiree, that instantly triggers fear. You hear the word loss or debt, and your stomach drops. Why? Because you remember the dot-com crash. You remember 2008. You know what happens when companies spend money they do not have, leave investors holding an empty bag, and ruin retirement portfolios. Your fear is that ServiceTitan is just another one of these tech companies burning through cash, getting ready to hit a wall, and taking your retirement funds down with it if you or your mutual funds happen to hold it. So let us answer the core question directly. What is the debt of ServiceTitan? If you look at their official financial reports, their long-term debt dropped to zero. They effectively wiped out their traditional long-term debt obligations using the cash and capital restructuring from their initial public offering. But if you dig into their overall balance sheet liabilities, which includes short-term obligations and operational leases, their total debt footprint sits around $51 million. Now, to a regular person, $51 million sounds like an absolute mountain of money. It sounds terrifying. But in the world of corporate finance, you have to look at debt relative to what a company actually owns and what it brings in. ServiceTitan has over $400 million in cash sitting in the bank. They have an annualized revenue run rate that has crossed over $1 billion. When you have $400 million in cash and $1 billion in revenue, a total debt obligation of $51 million is not a crisis. It is a drop in the bucket. It means they could write a check tomorrow, wipe out every single dollar of that debt, and still have a massive pile of cash left over to run their business. Macro trends +2. But here is where the real confusion sets in, and this is the trap that trips up almost every single retiree trying to read financial news. People see that ServiceTitan reported a GAAP net loss of nearly $160 million for their fiscal year. And you ask yourself, Susie, how can you tell me their debt is fine if they are losing $160 million a year? Where is that money going if it isn't turning into massive debt? Listen to me closely. There is a massive difference between a company having high debt and a company investing heavily in its own growth. ServiceTitan is a software platform. They build the operating system for the trades, plumbers, electricians, HVAC contractors. Once a business signs up for their software, they almost never leave. Their gross dollar retention is over 95%. That means their revenue is highly predictable. The reason they are showing a net loss on paper is not because they are buried under high-interest debt that they cannot pay back. It is because they are intentionally spending their money on sales, marketing, and developing new technology like artificial intelligence tools to capture the market. On a non-GAAP basis, which strips out one-time accounting charges and stock-based compensation for employees, their operating income is actually positive, bringing in tens of millions of dollars. More importantly for you, their free cash flow is positive. They are generating more cash from their daily operations than they are spending to keep the lights on. They are not borrowing money from banks at high interest rates just to survive. Investor relations, ServiceTitan +3. So what is the actionable takeaway for your life and your money today? First, do not let raw headline numbers scare you out of sound financial decisions. If you own an aggregate tech fund or a total market index fund in your 401k or IRA, you likely have exposure to companies like ServiceTitan. You do not need to panic and sell your diversified funds because you saw a headline about a tech company reporting a net loss. ServiceTitan's debt structure is remarkably clean, and they are well capitalized with that $400 million cash cushion. Second, if you are thinking about buying individual shares of the stock because you think it is a high-growth opportunity, you have to ask yourself if individual growth stocks belong in your portfolio at this stage of your life. When you are retired, your number one priority is protection, income, and peace of mind. Growth stocks are volatile. Even a company with a clean debt sheet can see its stock price swing wildly based on market sentiment or interest rate changes. If you cannot afford to see a stock drop 20% in a month without losing sleep or needing that cash for your monthly expenses, then you do not belong in individual tech stocks right now. You belong in safe, income-producing vehicles. Your money must work for you, but it must also let you sleep at night. ServiceTitan does not have a debt crisis. They have a deliberate growth strategy. The company is financially stable enough to manage its liabilities easily. Know the facts, understand the difference between debt and growth, and keep your retirement money aligned with your actual tolerance for risk. Simply Wall Street.